Good afternoon, everybody. For those of you in the Western States, still good morning. Welcome to our first webinar series for the year. My name is Jonathan Wu. I'm the Chief Investment Specialist of Prem China Funds Management, and great to see a huge number of people are interested to listen to an update on Asia and where we stand. Quite a lot to get through today, so I'm going to jump right in. I'm going to try to keep it within 30 minutes. This is being recorded as always, so if you have colleagues later on that are interested in viewing this content, please feel free to share it with them. You'll get a link afterwards, as well as this slide deck. So standard disclaimer for those on the call, everything that I say is of general advice nature only, and please seek professional financial advice as required. So a quick update on our investment team of value partners based in Hong Kong. They manage $10 billion US, sort of $4 billion in fixed income and $6 billion in equities. And obviously, as most of you know, one of the greatest assets that we have is that the management and the track records that you see on all of our funds are managed by the same principals that were started with the practice or founded the practice in 1993. So even as at today, even though Value Partners is a listed asset manager and still the only listed asset manager in Hong Kong, 43% of the equity is still owned by management and the co-founders, which is fantastic to see. In total, we still have around 70 investment professionals covering fixed income and equities, looking for the best opportunities for you. And especially what's happened sort of derived over the last 6 months, it's definitely very clear that the situation in terms of how much active research you need in Asia really drives those outcomes for investors. And because we have such a strong presence in Shanghai, Shenzhen, Kuala Lumpur, Singapore, London, and Beijing, it means that we have the best coverage across the region in terms of capturing the best ideas out of Asia. We do not pride ourselves on being good in developed markets. That's just not our forte. And at the same time, you know, you either are good at developed markets or you're good with emerging markets, of which in reality 80% is Asia. So we're what we call a relative value manager. We look for contrarian ideas, and I'm going to sort of share with you some of those contrarian ideas because it's been a while since these contrarian ideas have actually started reappearing in our top 10 holdings of the strategies. And we're always bottom up. We really don't care what the index is. So right now the index is sort of 30% Tencent and Alibaba. We hold very, very little in Alibaba, and we're going to talk about Alibaba a bit later on as a specific case study because it really highlights the difference between people on the ground and not having people on the ground, and sort of the investment decisions that made on the back of that and how that has also impacted investor returns. The way that we find those values and to find the best companies is that we do over 6,500 company visits. And on average, really, we're doing over 7,000 a year, which is something that's simply unheard of. And that's, you know, driven what the returns have been for our investors and why we pride ourselves on those returns and why investors have always stuck with us over the long term. So jumping into sort of the macro picture, let's have a look at where the value divergence is now, and it's probably quite stark, and there's sort of what we call a lot of front loading of problems that I'm going to talk about in a minute. But when you simply look at the PE ratios across the globe at the moment, you really need to consider where your asset allocation is and really what is the margin of safety for each portion of your equities portfolio. So what we've done is we've compared pretty much all of Asia alongside the world as well as the United States, right? So for those of you that are retail investors on the call today, the simple answer is this: does investing in the US market as it stands now with the headwinds we're going to talk about, investing $1 today, you're needing to wait 21 years of future earnings to make up your dollar? Or would you prefer to be in Asia ex-Japan at 13 times, or taking 13 years instead of 21 years to get back that same dollar that you invested in the market? The margin of safety is really important in a rate rising environment, and we're going to address that in a minute, and we're going to sort of compare and contrast the US and China situation. But right now, everyone needs to take a really solid look at where their portfolio positioning is in terms of relative valuations. If we then look at where the world is and where the world stands, I think we can all agree that the US-driven world that we've seen for the better part of the last half century or so has passed. Okay, that doesn't mean the US is going to collapse, right? What we're saying is that the US-driven world has passed. It's now going to be run by a number of superpowers, including the United States. Okay, so United States, China, India to a certain extent over time, but their democracy obviously hampers quite a bit of their ongoing development. We've then got an environmental crisis that we're dealing with. At the end of the day, we're talking about climate change, we're talking pollution levels, we're talking about the loss of biodiversity across the world. We've got demographic disruption, where we've got issues of, not enough healthcare technology, or the healthcare technology in some aspects of the system are too good. People's lives are living too long, but then you don't have enough people in the next generation, leading to that coffin-shaped demographic curve that we're all quite fearful of, and how governments are also responding to that, because that is a problem that is only going to grow. It's not going to get any better. And recently I was watching a documentary on Japan, and it's predicted that by 2040, half of the population of Japan will be living alone. In Japan, they've got idiosyncratic cultural issues where people actually don't want to get married, they don't want to date, they don't want to have children because they don't actually see any benefit. You then extrapolate that issue about how sustainable are pension systems, and that demographic disruption is going to impact the world. Then we've got social inclusion. And social inclusion is effectively the greatest ethical demand of our age. People are wanting a better quality of life. And what we're seeing over the last sort of 10 years is that we've seen a lot of populist governments come up and rise up. And China specifically has learned off the back of that. And they're effectively front loading their problems to ensure they don't give rise to social unrest. And that's driven through the Common Prosperity campaign that we've talked about. And that leads into what happened with the equity market for the better part of the second half of last year, leading to that correction. And that's perfectly normal. And we're perfectly fine with how that's played out. Then we've got smart machines and digital society. So we're talking about things like digital currency. China's rolling out its own digital RMB. We're talking about smart machines, self-driving taxis, all those things that are going to benefit society and make things faster. But at the same time, our reliance on technology is going to be ever increasing, and that's going to lead to that semiconductor theme that I'm going to sort of talk through today as well. And finally, we have wealth and well-being. And this is that ongoing quest as a society. As societies get richer, just finding out that the GDP, that their own GDP or their own income is higher than the average, or the GDP per capita in their own society, or an OECD average, for example, hardly defines what is well-being in today's society, right? The quest is now for in an absolute increase and tangible increase in the quality of life. And that, these 6 things is what's going to drive investment opportunity. It's also going to drive risk. But then as an active manager, and when you look at the world, you really want to be able to deep dive into those certain parts of the market. Where are the catalysts for you to make money? How do you actually drive sustainable growth for portfolios going forward? If we compare where the US and China sit now on a PPP basis, it is very clear that China, or using the McDonald's index, China has actually now outgrown the United States since around 2016. And it's well on their way to becoming the world's largest economy in the world. Again, even when China becomes the world's largest economy on a nominal GDP basis, it won't remove the United States out of the picture, right? It is not a one country gambit we're playing on, right? But when you look at asset allocation, when you compare how much investor portfolios are invested in the United States versus China, it's a huge divergence and doesn't reflect the actual state of the world. And where we sit today in terms of that opportunity set compared to even 8 months ago, especially in equities, there is a huge opportunity for which investors can tap into at a very, very attractive price. And we're going to sort of go through those themes. What I've done here as well is basically do a line by line comparison between where the China and the United States sits and where potential headwinds or tailwinds may arise. The whole world is talking about inflation, or really the whole world was talking about inflation since the beginning of 2021, and the United States is now at 7.5%. Arguably, you can say that the US Fed has been too late or behind the 8 ball with regards to increasing interest rates earlier, and we all know the impact of that. If you were too late to start increasing interest rates, it means that when you finally do start increasing interest rates, the rate at which you increase rates is going to be faster. If your rate goes faster or goes up faster than what was previously expected, and there could potentially be somewhere in the auspices of 5 rate rises this year in the United States, you now face a problem whereby you are cutting off or slowing down the economy much faster than you may have originally intended. China's inflation rate is sitting at sub 1%, which is not optimal for them either, but it's not a problem that's leading them to having to increase rates. Then you look at central bank interest rates. China is 2.85 versus the United States of 25 basis points. Now, China has the ammunition required in 2 different ways. One is the reserve ratio cut. For those in Australia, we're talking about Tier 1 capital ratios. Those can be cut to basically put more liquidity into the market, or they can simply reduce interest rates. Okay, reducing interest rates in China isn't the blunt instrument that you see or has the same level of impact as you see in the US or in Australia, or even New Zealand for that matter, because Chinese as a population doesn't carry the same amount of debt as you see in other places. At the same time, anecdotally, we've seen that since the GFC, the United States Federal Reserve's balance sheet has grown by about 5 times, Japan's grown about 3 times, and China's People's Bank of China, their central bank, has grown their balance sheet by about 1.5 times. This is representative of the conservative nature of China overall, which also leads to them facing less headwinds, because when the United States increase rates, obviously their interest bill also increases at a pretty exponential pace. Then we have a Gini coefficient problem. And this is sort of where I want to address the elephant in the room. Going back to the comment I made earlier about populist governments and why we've seen so much social unrest is because Gini coefficients keep going down or getting worse. And both China and the United States Gini coefficients sit today at about 0.4. Okay, Australia's about 0.5 because we have such high levels of social security, and I would suspect that New Zealand's probably about the same. So China and the United States both face the same problem, and they've gotten worse in recent years. The United States are doing nothing about it. Now, you fundamentally think about why Donald Trump got elected, and this is less of a political statement, but just the reality is because people are disillusioned. China's seen what happened with Donald Trump. China's seen with storming the Capitol on January the 6th last year. All these things is because people are very in a discontent mode. And that's why China last year came out with the Common Prosperity policy measures. And it was very aggressive. It was delivered with all the nuance of a sledgehammer, but it worked. It reset the psyche of the Chinese population. And it sort of give you an idea of what that means in a sort of a real life scenario. If you asked a child in China 30 years ago what they wanted to be when they grow up, and they said, I want to be a scientist, I want to be an engineer, and those things contribute to society. You ask nowadays a kid what they want to be in China, they want to be the next Justin Bieber of China. Well, that doesn't actually contribute to society. It actually just generates worse diversion between rich and poor, because you think about why you want to be Justin Bieber is because you want to be rich, you want to be famous. It doesn't actually propel the economy forward as a population. So, one thing that we're very clear about going forward is that, you need to separate between the attack that the government has done in its policy implementation, right, towards the common prosperity goal, and the ability to make money in China, because those are 2 very, very different things. What you will not see going forward in China is another Jack Ma or the equivalent of a Mark Zuckerberg or a Jeff Bezos. These people and their equivalents in the United States are basically in a large way controlling policy direction in the United States solely because of their sheer size and the makeup of their capital market. In China, they want to stop that from happening, and Jack Ma, back in 2020, with the failed and financial listing is the best example of that. That doesn't mean you can't become a billionaire in China. What China is trying to foster is they're trying to foster a culture of innovation, right? To ensure that in the future, China has a sustainable property market and a sustainable technological market, which is not controlled by a single monopoly, because that is in itself very, very dangerous. If we then look at where the policy lines sit within China, what you see here is that they're focusing on both the supply side as well as the demand side, all right? And a lot of this has to do with the fact that China has realized that given the aggression by the United States, they have to sort of take lessons from what happened in the late 80s when the US put a lot of pressure on Japan, and Japan wasn't able to react in the same way China can, in the sense of having a very, very strong domestic market. China has that now. So they're trying to increase what we call time cost compression, which is effectively no matter where you live in China, you can still contribute and generate good amounts of GDP. So that's the generation of smart city development. When we're talking about even urbanization in China now, it is no longer moving from cities. It's actually developing the town that you're already in into a smart city. Then you've got the longer and smarter high-speed rail network, right, which is the cornerstone of China's development. You consider where that is and the benefits that a rail network benefited Japan 30 years ago, and what that did and transformed the United States, or the continental United States, over 100 years ago, right? It created huge amounts of time cost compression. There's been no or very lack of infrastructure spending since there in the United States. In China, it's all about that high-speed rail network, okay? Then you've got facilitating consumption reshoring, which is really trying to say, okay, we're going to manufacture goods in China for domestic consumption because we don't know what the West may want to do in targeting certain things that they want to over a period of time. Then on the demand side, right, you're enhancing labor compensation, okay, so minimum wage laws. You've got things like superannuation that's been implemented for the better part of 10 years for urban residents on a co-contribution scheme. You've got lowering precautionary spending. This is completely psychological. So what do I mean by that? Chinese people have huge amounts of savings. We're talking about 30% of gross income. So what's happening into the future is that the Chinese government wants to lower that level of precautionary spending and have people invest more money, but be more diversified in the way that they're spending their money, okay? And that's going to unlock a whole lot of other themes, which I'll talk about in a minute. And then finally, they're trying to reduce income inequality, okay, which is talking about the Gini coefficient situation I referred to just then. So one of the domestic consumption plays that we've made a lot of money on over the last better part of 2 to 3 years, especially since the pandemic started, is sportswear. So sportswear, you've got basically two main brands, Anta Brands and Li-Ning. Most people in the West have heard of Li-Ning. They may not have heard of Anta, but it's effectively the equivalent of Nike and Adidas. And what's happening in China is that the Chinese government is also subliminally trying to encourage people to exercise more. And so what you see is that there's more sports facilities that's being built, as well as the actual amount of people that are actually spending time exercising. Now, sportswear is just one example, because on the bottom half of this chart, what you can see here is that the retail sales CAGR estimated over time is going to dramatically increase more exponentially, as you see with things like sportswear. Now, from a portfolio basis, remember, good companies are great, but good companies trading expensive valuations is not what we're after. So we've made a lot of money in sportswear. We sort of rotated out. We started going back into more industrial companies like dairy. So you sort of see dairy in the middle of this chart here, because they're not trading at such a high premium, and same with alcoholic drinks. Okay, there's a lot of companies in China and across Asia that we really love, but there's certain parts of the cycle where we simply don't want to participate because they're simply too expensive. Then there's the semiconductor theme, and the semiconductor theme is not going away. Through all the supply chain checks that we've done, even in this calendar year so far, all orders for semiconductors for 2022 are already at capacity. You can't order another chip for 2022. And the other key reason is because remember, and I talked about this last year, semiconductor orders need to be put in 6 months before you actually get delivered, because it actually takes 6 months to deliver it. So if we use the example of Apple iPhones, and this year is going to be quite interesting because there was a news article today that because of the efficiency levels that Apple is trying to get to, meaning that making their batteries last longer by having more efficient SoCs or systems on a chip, that they're probably looking at even dumping Samsung this year and going all to TSMC, because TSMC will have the 4nm chip set ready. But outside of phones, you look at the incremental growth of devices or IoT or Internet of Things devices that's going to grow all the way to 2025. So the semiconductor story was partially created because of COVID, but now COVID is sort of moved on in the greater scheme of things, and now is getting reasonably close to being an endemic. If we look forward, the demand of chips is still going to be there. And if you use a local example right now, if you try to order a car, you're going to be waiting for the better part of 6 to 8 months to get that car, and so on and so forth. This situation is not going away. From our perspective, we think TSMC and Samsung are still great companies, and TSMC still features in our portfolios. But we've actually started moving the portfolio away from these companies, or slightly reducing them, to make way for other chip manufacturers that are building larger chips, but is still going to be still a major beneficiary of the tailwind of semiconductor growth going forward. And what you see here is that if you look at the 10nm chips, so the smaller the chip, the more sophisticated, the better the margin, the bigger the demand. You look at 90% of Taiwan's production is less than 10nm chips, okay? And the demand, even just for high performance computing in Asia, right, that performance and that growth, which is that blue part of that bar, is going to be the largest part going forward. Then there's a third theme that I want to talk about. And that third theme is wealth management services. Remember I talked about China needs to get its population to lower precautionary savings. So this is one way. If you look at the comparison here on the right-hand side, you can see that the split of investment across different types of countries. So in China, 60% of household asset allocation is in property. This is why the government's attacking property. They don't want property to the be-all and end-all. But you look at other financial products, 8%. That includes equity funds. Okay, people haven't participated in equity funds historically or other types of wealth management products in China unless you're the super rich. But now with the rising middle class, there are more and more people that are demanding that. And as precautionary spending or precautionary savings, goes down even further, it's going to improve and going to create even more demand for wealth management services. So if we consider where the portfolio sits for the Prim China and the Prim Asia fund, at the moment, it's in sort of three main buckets. We've got technology names with less headwinds or tailwinds. So Meituan, which is the equivalent of Uber Eats, we were in that quite aggressively in 2020. We got out, we're now back in. Again, great company, just different parts of the cycle spins off different types of valuations, which we will or will not accept on behalf of our investors, right? You can always have a great company, but it's a terrible price. Tencent is still a staple in our portfolio because they are least impacted by headwinds by government change of policy, TSMC, as well as UMC. So UMC is United Manufacturing Corporation. It is the larger chip manufacturer, or the larger nanometer chip manufacturer. Domestic consumption, domestic brands, Mingniu, so that's Fresh Dairy Products. China Merchants Bank, which is not a traditional retail bank. We don't like traditional retail banks. So we're investing in wealth platforms, so the equivalents of Macquarie Wrap or Net Wealth or Hub, as well as private bank services. And Merida, which is the e-bike company, which we had invested throughout last year. Valuations are still reasonable. We quite like it. What is interesting, though, is on the far right-hand side is the value with conviction part of the portfolio. This is something that, to be honest, hasn't been seen in our portfolio since around 2009. So what's driven that? Value with conviction relates to companies that, given the impact of government policy last year, valuations have basically shot through the floor. And all of a sudden, these very industrial, big traditional names become very interesting for us. And they have very interesting investment theses. That's more related to China Mobile and CNOC. China Resources Land is a property developer. And now all of you are going to say, geez, Jonathan, you guys have really got a lot of kahunas to go back into the property market at the moment. Yes, that is true. But when the entire property market is currently trading at a 70% discount to the net asset value of their balance sheet, again, we're going back to this theory of margin of safety. You want to buy things on the cheap, and that's what our portfolio currently represents. What we have avoided, we've avoided Alibaba, and I'll talk about that in a minute. We've avoided K9 Education completely. We never had a single stock holding prior to the attack by the government last year, and we've basically abandoned all property developers for 3 years until now. Let's talk about Alibaba. And I'm going to make it very, very transparent for everyone to see where we got out and where we got in. As you can see here, Alibaba is a great business. I don't think I need to explain to anybody what they are. They're basically the Amazon of China. Cloud services, cloud computing, e-commerce, so on and so forth, even EVs. So company's great. Then in sort of September, October, there was a lot of talk around the Ant Financial listing. We had parked cash ready to deploy into the Ant Financial listing. And then in October, Jack Ma decided to say something that was very, very, not PC, if you can put it that way, and say Ant Financial fills in a portion of the market that the banking system doesn't cater for in terms of micro lending. When 68% of the Chinese banking system is controlled by the central government, it's not the wisest thing to say. Ant Financial listing got caned. It never happened. And then we decided to exit at that point. Why did we decide to exit Alibaba at that point? Because Ant Financial was going to be spun out of Alibaba as a holding company into its own separate listed co. The reason is because at that point, we already knew what was the biggest competitive advantage of Alibaba's business model, was their monopolistic practices, whereby if you signed on and sold your products through Alibaba's Tmall or Taobao, you can't sign with anybody else, which meant it was basically Alibaba controlled a monopoly. We knew at some point in time, given the fact Jack Ma's less than intelligent comment, is that at some point the government's going to attack that, and it's going to mean their growth is not going to be so great anymore. So we completely sold out by early November. Then the share price basically halved, and then we sort of thought this is starting to get interesting. Now, here's the difference between Western managers buying China and Chinese managers buying China. We inherently know what's actually happening in Alibaba. We're not holding Alibaba because we need to be benchmark weighted. We don't manage huge amounts of money, which is great for investors because you want high conviction portfolios, right, driven by high conviction managers, not because we're allocating to Alibaba and Tencent because they're 30% of the benchmark. So almost the whole of the calendar year of 2021, we held zero Alibaba, and Alibaba is 50% of the benchmark. That's how much conviction we had in not being part of that crowd. And we missed out on partial that recovery in the fourth quarter of last year, where you see the share price went from $140 to about sort of 160 again. But then in mid-November, we decided to pull the trigger. We have a very small position. It's less than 1% today. But what we're trying to continuously calculate almost on a week-to-week or month-by-month basis is this question. What is challenging Alibaba? While Alibaba is a fantastic business, its largest challenge is that will the growth of Alibaba be driven enough by the increase in total market growth of e-commerce globally, because Alibaba operates globally, versus their decrease in market share due to the likes of VIP Shop or Meituan or JD.com that we were in previously due to increased competition. This is the challenge for Alibaba going forward, which continuously re-rates our valuation for them. In the old business world, before the Chinese government implementation of policy, it was quite simple to say, we've got if Alibaba ever trades anywhere below 25 times, it's a great buy. If it gets to 38 times, we're out. Now with the adjusted business model, it's now sort of between 15 to 25 times in terms of what we think is reasonable in terms of valuation on the upper and the lower end. As you all know, all the funds hold recommended ratings from major research houses, which is fantastic, and those were reconfirmed in 2021 again. And this is our current return profile. Again, the incumbent is Platinum Asia. Last year was a tough year, and for a long-only fund versus a long-short fund, which has the capability of shorting very aggressively, we still outperform them by over 800 basis points net of fees. Okay, and so our fee is cheaper than the incumbent. Our performance is better than the incumbent, and we're now on major platforms. We just recently went live on Premium, and we should be soon to go live on Colonial First Wrap as well. In terms of our sharpened information ratios, you can see here very, very strong over all time periods, even over 1 year when we've had that correction in markets. The fund has still performed extremely strongly on a risk-adjusted basis. In terms of that geographical exposure, we now have a structural slight underweight to South Korea. We hold very, very little. I think we hold one stock in India at the moment, which is in the others portion. Our Taiwan exposure has increased because of the semiconductor sort of position that we have, and you'll also see that our A shares is remaining reasonably steady at about 12%. We suspect that over time that the A share allocation will increase more, and that will be driven by more participation even by local retail participants in the local equity markets. What is most attractive at the moment in terms of our collective group of companies in this portfolio is that the PE of the fund is 11.69 times on a forward 12-month looking basis. That's cheaper what I presented earlier in terms of the whole market. So we have a collective group of companies where the asset allocation, right, is over half of it is made up of consumer stocks and IT, right, about 2/3 of the portfolio. It's trading at 11 times. And the dividend yield has also ticked over 3%. These are good quality cash flow generating companies that provide the total return forecast that we're looking to achieve for investors going forward. With the Premium China Fund, our long-term track record, again, still very strong. We're getting close to sort of 17 years, and thank you for those that have been, supporters of ours for the last 17 years. We hope we've delivered the outcome that you wanted. And with this portfolio, obviously, because it's a more specific Greater China Fund, you can see that the A share exposure is all the way to 20%. Again, expect that one to increase. Again, here in this portfolio, IT, communication services plus 2 consumer groups is about 2/3 of the portfolio again. And what you see here again is that the portfolio for the China Fund is about 12.6 times, forward-looking 12-month basis. Where we've made more money in this portfolio over the last 12 months in total contribution has been shipping companies. We're basically out of shipping now. We were out of shipping late last year solely because valuations were off the chart. They were pricing in even further growth in shipping prices. We think that's going to be very difficult solely because of the fact that inflation is already pushing at that higher point in the cycle. But yeah, that's where we sit now. That's all I sort of want to cover off. Here's our contact details as you see up on the screen. There are sort of 2 questions that have come up on my screen that I'll try to address now. So the first question is, how will the Chinese provinces fund themselves now that the land sale gravy train has derailed? Okay, so there's a couple of things to unpack there. It is true, local governments or provincial governments, specifically local governments, derived a big chunk of their income from land sales, and that drove a lot of their revenue overall as a province. What's happened is that in January, we saw a record level of local government bond issuance that was higher than what was seen in the previous 2 calendar years. So we're seeing the Chinese government actually allow what they call special bond issuance and basically increase that upfront liquidity for governments going forward. In saying that, the gravy train that people are referring to doesn't actually stop in an absolute sense, because governments still will sell land. It's just that it's going to be at more controlled prices. If we consider the property sector going forward, is it a bad sector to be in? It's not a great sector to be in as an equity investor, because the ROEs have dropped. The returns that property developers used to generate on a gross basis of 40, 50%, and then netting of all costs, you end up being around 20% will no longer occur, okay? Because property price will be more controlled. That's great for the broad population, but the local government still need to sell land. So while it's not going to be as elevated as it was before, it's still going to be an area that's going to be investable, but more so for the fixed income fund, which I'm obviously doing the webinar for tomorrow. And we're going to do a little bit more deep dive on that basis for in terms of the property sector. So please tune into that tomorrow if you're free at the same time, 12 p.m. Sydney Eastern Standard Daylight Saving Time. Second question, how can you put any valuation on Alibaba given its dependence on acquiescing to the CCP? There is still a valuation, because the valuation is still based on its cash flows. That doesn't change no matter what the government and its relationship with Alibaba is. Remember, Alibaba is still a very, very diversified business. It has a lot of assets in cloud computing, and that's the part of their business that's growing faster than other parts, because e-commerce has a lower barrier to entry. Cloud computing has a much higher barrier to entry solely because of the capex of servers. And security that's related to those servers. So Alibaba still has a great business that, of course, you can still value. In the same way, you could ask the same question of how can you value a property developer if the government is sticking their hands into the sector? Of course you can. At the moment, it's just more so the fact that when we're valuing property developers, we're looking at discounted NAVs, because you're trying to basically pick the best of all property developers. And with our fixed income team at the moment, we've even split those property developers into 3 different categories: category 1, 2, and 3, category 1 being the best, which I'll walk through a bit more tomorrow. But you can always value a company, and it's all dependent on the cash flows and sort of where we predict or forecast where they're going to be sort of 12 months to 24 months ahead. We don't do any forecasting more than about 3 years. We believe the reason for that is because markets dynamically change. Number 2, government policy changed. And probably one last macro thing to watch out for when people are asking me, okay, when the markets are going to turn around, Jonathan, is that sort of watch out for the policy nuances that's going to come out in March through the 2 session meetings that's going to occur. That's going to be early to mid-March. And then, from there, we're going to get a better idea of where the government's heading. We suspect it's going to be loosening. We're going to be suspect that this year is going to be less about policy and more about digestion of the policy that's already been launched, and it's maybe some fine tuning on the sides. But the government is not in a position where they're trying to debilitate the economy. That's just silly. The reason why they've been silent since the beginning of this year is that they've had sort of 3 targets that they've been trying to get over. 1, put on a really good show for the Winter Olympics. Number 2 is that they need to sort of make a concerted decision as to what they're going to do with Omicron, because China and Hong Kong by association has always focused on having a COVID-0 policy. Hong Kong, as most of you may or may not be noticing in the press, there are about 7,000 cases, and that's up from about better part of 10 or 30 cases a day only less than 3 weeks ago. So how they're going to battle that COVID, the Omicron variant, is going to be very interesting, whether or not they're going to still stick to 0, or they're just going to deal with treating patients at a mass level. That was the second thing. And the third thing is what's going to happen in March with those meetings. So after March, we're going to see what's going to happen. We're going to get more clarity, and then from there, it's going to then also help derive what our sort of investment thesis is going forward, even for the rest of the region, for the next 12 months. And finally, links to TMDs will be in the presentation as usual in the deck, so automatic click-throughs for you there. And as always, if there's any other further questions, please reach out to myself or Derek. Tomorrow, same time as I said, 12 p.m. Eastern Standard Daylight Saving Time, we'll have the Asia Income Fund and Fixed Income Market Update. So hopefully some of you can tune in then. But at this point, I wish everyone a great afternoon and rest of the week. Thank you.